taking a look at the charts, equities are down a little bit this morning, down about 1/3 to 0.5%, depending on the index. A couple of interesting things kind of unfolding. Again, we're in really choppy, volatile markets, which means we can have all kinds of haywire, and short-term signals generally aren't that accurate. But if we take a look, we can see the market had a big rally there yesterday, pushing higher. We have it dipping into this red background area, saying that the trend is down and it's getting overbought. We also had FOMO buying again yesterday. That's 2 days back to back. But again, the momentum and the bounce that could take place here, this V-shaped recovery bounce, makes it so it's really difficult to gauge if the market is going to roll over and sell off. All we know is the longer term trend is down, and this is a bounce up towards the 20-day. But again, when we take a look at our overall cycle analysis, it is showing that we should see this market continue to bounce up for potentially several more sessions or work its way sideways or higher. So again, it's a real crapshoot of what the market is going to do. We got a lot of extreme kind of mixed signals in the market, and we just have to let things kind of shake themselves out and see how they unfold. Now, if we take a look over at the Nasdaq, it's down about 0.5% this morning, kind of stalling out a little bit more. You can see here, if we look at the 30-minute chart, we've got peaked here. This is a pretty significant area. This was a significant low. We had a couple other little dip lows there. We had some trading through here, kind of hit its head on that level and then sold off. And now it's come back up to this area. So the market definitely struggling a little bit when you look at the Nasdaq, which is kind of the heavyweight in terms of if the Nasdaq moves down, the Magnificent Sevens are kind of probably also in a similar pattern. In fact, we look at the Magnificent Seven here. This is a pretty tight little pattern. It really is actually refusing to bounce. It's just pausing. That's not a good sign. That is seen as a bear flag, meaning we could have another big drop to the downside, which is what I talked about last week. Last week we talked about this little bit of a pause right here in the market. I talked about how the market was expected to potentially move down for a fairly significant run. And the market, if it doesn't shake you out, it will wait you out. And that's what it's doing. It's kind of going into a larger bear flag pattern, which actually points to potentially even further pricing to the downside. And that is kind of the bias. The trend is down. It's a bearish price action. Wherever the mags go is probably where the market is going to go. A lot like NVIDIA was kind of like the leader there for a while. Where NVIDIA goes, the market goes. Well, the Magnificent Seven, I think, are that on steroids, because it's obviously 7 big companies that have a much larger weighting of the overall markets, and they're struggling quite a bit. If we take a look at NVIDIA real quick, NVIDIA has had a bit more of a bounce. It gapped higher yesterday and sold down. A little bit of an exhaustion type of gap when we see these types of price action. This was that same type of bar, very similar here, another one over here, another one over here, and of course we had one yesterday. Looking at our short-term 30-minute chart, bars are red. 20-day moving average is here. We have the market pushing into this overbought territory. We have FOMO on the market. We have sell short signals. Again, we're not trading or selling short in this market. This is a short-term momentum strategy. But again, a lot of things are pointing to probably see some very big chop here. But overall, usually we're going to see a downtrend is likely to continue to beat down. And so sellers, it's just a matter of time, I think, before sellers step back in and unleash the fury with lightening their portfolios with these stocks and NVIDIA in a nutshell. Obviously, a series of lower highs, a series of lower lows, and that is the definition of a downtrend. Let's take a look where money is flowing today. We are seeing money flow into the dollar. Very little. It is. I feel like the tariff nonsense is obviously it's still applying weight, but it's starting to lose momentum to the downside. It's not free falling and collapsing. It's being digested and worked into the price. And of course, longer term, the dollar index is pretty much right at a midway point through the middle of all of this, and it's trying to hold its ground from that perspective. Gold is having a nice move today. Again, uncertainty brings to life gold. We're seeing gold push up. We have that 3,050 to 3,060 upward target we talked about several weeks ago. That's the next, actually, I think it was even a couple months ago. That is the next potential move if gold was to run. And we have now broken 3,000 finally. It was flirting with it for a while. today's a pretty strong move above it. We'll see if it can hold, which I think it will. And gold is still in that favorable environment. It has had a little bit of an oversold territory a few sessions ago after taking a bit of a run up and pause, and now it's having that kind of run to the upside. If we take a look at silver, up 2%. Silver's having that nice push up. We talked about how 35 is the next upside target for silver. And I do believe, if I can go back far enough here, I do believe we could eventually see it come up to 36 and potentially right up here to 37.50. Those are the next kind of upside targets. Silver has a little bit more of a bearish price action in my opinion here, based on a surge to a high, sharp pullback, surge to a nominal high, pullback. And I think we're about to push a nominal new high and then pull back. And if you go into our education section into the members area, there is a video that talks about these 3 surges to a high and how they can be they're a high volatility play, generally a very bearish pattern. And that's when we see a big crack and a big wipeout in the end. So that's my concern with silver. But again, right now we are in that sweet spot for precious metals in general, the sector, to hold up or move higher. And nothing has changed from there for really the last year and a half or so, where we're blatantly in that environment, and they have been moving up and to the right ever since, and reaching each target kind of one at a time from there. If we take a look over at energy real quick, we have oil up 1% this morning. Again, it's got a little bit of a bearish price action here. It's having a little pop and squeeze up to the 20-day into this little breakdown zone. The trend is down. It actually looks, obviously, if you look here, this is a little bit of a pennant formation or a bear flag, whatever you want to call it. It's kind of dipping into oversold territory yesterday, and today it's going to be up at 40. It's trading at, what is it trading at? 68.30. 68.30. So it's going to be right up at the 20-day moving average and push probably deeper into overbought territory. We'll see if sellers step in there and have it run back down towards the 66 if this is a little bit of a bearish price action. And if this bear flag does play out, we could see a much bigger move down in energy. We could see, just based on this little bear flag of where it is right now, that actually could send it all the way down, oil to $60 a barrel, which would break the 66 critical support. And that could wreak havoc for the energy sector, which, if we take a look at XLE, it has been coming to life and having a pop. Again, I'm bearish. My opinion is bearish on the energy sector. I think it's going to be a really interesting in short trade slash inverse ETF trade. It has been moving up. Now more so, I think it is moving sideways. So it is putting in a major top. I know some of you have already bought leveraged inverse ETFs, and you're trying to front run it. Again, I'm not a huge fan of front running something. It means you're trying to pick a top, and it means it's just not a good strategy. It's much better to wait for it to break down and have a rebound, and then buy an inverse ETF on the reaction highs. So right now we have a series of higher highs, higher lows. It creates this bandsaw blade and double or triple top. Eventually we're going to see a crack to the downside, then it's going to bounce up, and then this is kind of where you look to buy an inverse ETF, or as it starts to roll over and we start a new downtrend in the market, that's where you buy an inverse ETF, and then it has that drop down and you profit from this middle section, and then eventually it'll bounce up and it'll obviously create that bandsaw or the blade to the downside. We talked about this pattern last week. I showed a PDF on how these patterns kind of unfold, but shorting up here is just a really high risk. It's a typical trader price action of trying to pick a top, and it might work out really well for you in this particular situation, but if it does work out, it's actually going to do you more harm, because now you think you can pick a top. We've talked about this over and over again. Wait for confirmation, wait for the trend, and trade the trend. Don't try to pick a top or a bottom. It usually backfires in the long run and costs you a lot of money. All right, so where else? Let's take a look. Let's take a look over at let's take a look at the long-term trend. If we take a look at the long-term trend here, we've had this shift to the downside in the market. We're starting to get this bounce that we're kind of anticipating the markets to either trade bearish here or put in a bounce before rolling over. I believe the pullback that we've had is very similar to this one, and we're just waiting for this bounce. and for potentially a downward bias kind of bearish phase to kick in, which on the weekly chart, same type of thing. The market kind of reverses direction, eventually goes into a bearish phase for a while, and then that's where I kind of feel like we could see this bounce up for a week or two, and then potentially go into a deeper correction, which, as you know, could turn into the start of a financial reset, global financial reset. Looking over at, let's take a look at the SPY real quick. In the grand scheme of things, the market has moved down. There is a ton of selling, a ton of damage being done to this chart. Red bars can be seen as a bullish opportunity, but when we get too much of them, the trend and the wave is broken, the cycle. And so now we're letting the markets digest and figure themselves out if they're going to bounce up and provide an opportunity. But overall, again, stocks really are flat. They haven't really moved. Bonds are down. It just goes to show how the buy and hold strategy is very volatile, very choppy, and can be very costly, both in time and money. More so time. It's amazing how many decades are wasted with the buy and hold strategy over the lifetime of an investor. You'll probably, waste probably 10 to 20 years of investment of just letting things sit there and mature and go through these cycles when you could put it to work to do something else, and consistently be pushing to new all-time highs year after year versus treading water and wasting time. And that's the value of what we do. And we do wait a long time for signals, but we also don't ride things down 15, 20, 50% during corrections. Anyway, that is it for now, and we'll just go from there. Talk to you soon. Bye-bye.